All right, welcome out to today's market bias recap report for the week of Sunday, January 7th. This is Jeremy at Escape Velocity Trading, as always, helping you get prepared for the market week ahead. Diving right in, let's look at the S&P 500 futures chart first, currently trading at 4740 and below both our 9 EMA and 20 SMA. We are getting a bearish crossover right there, and I was saying for the last several weeks here that we were just so overextended and needed some time to cool off. Right now, you can see we have gotten an official sell signal on the RSI, crossing back below the 70 mark. And also, we have lost the momentum on the MACD. We've now set officially a lower low on the MACD here and looking for probably a lower high here as well. So for any bullish movements on the S&P, we are going to need some time off here. My actual analysis is that we are going lower here for a little bit. If we zoom in here on the weekly chart, we still have a distance to drop before we get to the rising 9 EMA, which will act as our level 1 support. That's going to be at 46.74, so about 80 points below our current level. I actually would not mind, and I said this in last week's video, a pullback back down into about the 4600 level. So about 140 points below current levels. I'm not really interested in playing anything on the bullish side until we get a little bit more of a pullback. I would like at least one more week of pullback here, maybe even two, coming back down into that 46 to 4640 level, somewhere right in there. Give us a doji on the weekly chart, clean up the daily chart a little bit, let these moving averages come down, sort themselves back out, and then give us a bullish crossover again here in a couple of weeks. If you believe seasonality in the marketplace, generally speaking, from basically this point in January through till the end of January, it is typical to have a sell-off and some consolidation after the Santa Claus rally that ends the previous trading year. So we are seeing that play out right now, and I don't see any reason why that will not continue to play out for this year, 2024. So that's kind of my predictions moving into the following trading week here. And like I said, not interested in any bullish movement here. I'm going to be seeing that as a potential opportunity to short, if anything, participating on the S&P 500. Going out to the NASDAQ is going to be very, very similar. Obviously different numbers, but basically identical pattern. The RSI has been crossed for a while here, bearish, and actually is looking a little bit healthier now than it is on the S&P 500. But we are getting that lower pivot high here, as well as the lower pivot low on the MACD, kind of showing that we still have maybe a little bit of time off. I doubt this is going to get back down to our previous pivot high here at around that 16,000 mark. I am expecting that this is probably going to consolidate most of this week on top of the rising 9 EMA. And that will set up kind of a high base, or excuse me, a low base situation here where we'll probably just kind of chop between the 20 period moving average and somewhere in that like 1600 to 16100 range, somewhere right in here. Basically looking for price to just chop back and forth within this range to eventually let these moving averages sort themselves out and give us a new break to the upside. That is my thought process on it. Does seem like it still needs a little bit more time to chill out. I'm guessing most of this week will just be a development week, hanging out between those two ranges. Going out to Russell 2000. Russell 2000, we're going to start out on weekly chart here. And you can see that we broke out, had a little bit of momentum, couldn't hold that breakout channel from basically the last year and a half of consolidation, came right back down into that range. We do have the rising 9 moving average here below us at about 1938. However, whenever you're in choppy, messy ranges like this, moving averages tend not to hold the same significance that they do when the market is in trending scenarios. And I'll back this out to a little bit longer time frame. You can see here that when it is trending, it respects those moving averages really, really well, right? This 9 EMA held really well for months and months and months during that trend. Here, when we aren't trending and we're just chopping back and forth, the 9 EMA doesn't seem to make much of a difference. Sometimes we kind of hover at it, other times we smash right through it. So it's kind of hard to tell right now if we are going to hold that level or if we're going to break down below that again. Honestly, the deeper on this we go, the more interested I will get on playing it to the upside again. But again, just like the S&P and NASDAQ, we need a little bit of time here to develop. And the daily chart really shows that we're getting that bearish cross at the 9 EMA, the rising 20. It wouldn't shock me to see this come up maybe to the 2000 level and then roll over again and come back down to either test this previous low or maybe even a little deeper down into the 1900 level before we eventually find a reversal and start moving higher once again. So I'm kind of anticipating that over the next week or two, we are headed lower on the Russell 2000. Going out to crude light. Crude light is starting to form up a decent base here. It's still below its 50-period moving average on the daily. Still has a little bit of work to do here on the weekly chart as well. If it does get above and holds above its 9 EMA here, you can see that price has basically been pinched between this decreasing weekly 9 and the 20-period SMA here as support. So looking for a break one way or the other. If I had to give a lean to this, I am going to call my shot and say we are moving higher. A break above this 9 EMA on the weekly chart should see us push back up to the 77.48 level. That coincides with the 50-period SMA on the weekly chart. So that's kind of my thoughts. I do see this probably taking a little bit of time to work itself out. The 50-period on the daily chart here will be acting as some resistance at the 75.33 level. So wouldn't be surprised to see us push up into that and consolidate back down into this 72 to 73 range this week, and then finally break out next week towards that 77.4 level. Going out to gold. Gold, kind of choppy, trying to hold the all-important 2000, 2050 range here that it's been kind of dialing in. If we toss this out to a weekly chart and remove those drawings to clean this up a little bit, we have a bullish signal here with my ATR stop triggers. We are above the 9. This is going to rely on what the US dollar does. And the US dollar, to me, looks like it has some rebound potential in it, maybe up to around 28. If this chart moves higher, it stands to reason that gold will probably break this 9 and come back down to test the 20. That won't be the end of the world. My thesis long-term on gold is still up. So any deeper pullbacks here, to me, are opportunities to scale in, to cash flow, sell naked puts, that kind of thing. But for any kind of directional play, I'm waiting a little bit longer here and looking for a little bit deeper of a pullback before I get involved. If we go out to natural gas is actually starting to look pretty interesting to me on a weekly chart here. Giving a nice bottoming pattern after a huge sell-off to start 2022 and then going into 2023. We are above most of the moving averages. If we get above $2.95 and have a close on the daily chart above that level, I don't see any reason that we wouldn't come back up to about that $3.50 zone. On the daily chart, you can see that also has kind of cleared not only the diagonal resistance that we've had for quite some time, but also the 50-period moving average. I wouldn't be turned off by this if we saw 2, 3, maybe even 4 days of just neutral consolidation here, hovering around this 50-period moving average, and then lining up a break of $3 up to 350. I would really like that setup, but to me, to get involved, I kind of want a few days off to consolidate here just because of the previous move on the daily chart. Finally, going out to silver. Silver, kind of a messy range. Had an opportunity to break out here and gain some momentum, lost that, Now, any bullish movement that we have here has to be looked at as a potential short opportunity in the short term, looking for it to roll back over and probably retest this $23 zone and maybe even back down to the $22 zone before I'm going to start getting interested again. If we put this out on a longer time frame chart, you can see kind of our rising diagonal support line right here. I wouldn't mind, honestly, if it broke the 200 period moving average here, came back down, tested, gave some nice support, and then set up a breakout somewhere down the line here in maybe mid-February to re-break out above that 200 period moving average. But that scenario is going to take several weeks to play out, obviously, going into mid to late February for that. But if we do get that, I will really, really like that breakout opportunity on silver. So I'm just kind of waiting and sitting on my hands for a little while, waiting to see if that chart develops. Going out, let's end real quick looking at the heat map from last week. This is a 1 week performance, and you can see a ton of red, mostly in big tech. Big tech has been leading the charge for the last couple of months in the market, and had basically been saying over the last couple of weeks in our market bias recap reports that it was way overextended and needed some sell-offs, needed some pullbacks in order to reset our risk to reward. So we are in the process of that right now. And even though that red looks really, really ugly, and when markets are overextended, technicians like myself always look at it and say, hey, like we need a pullback for the risk to reward to get reset and for us to have an opportunity again in the marketplace. It's never any fun when that materializes and you actually get that pullback that you want. Seeing all these big red numbers freaks people out, makes people get emotional with their trading, and that's where mistakes are made. So anyways, looking at this, tech is in the midst of a correction. I do see that probably continuing for another week or so. Any bounces that we have this week in tech, I'm going to be looking at as probably fake outs and or just setups for short opportunities again. Looking at the green here, we have financials and we have healthcare. I'm really interested in financials. I love the look of financials. Unfortunately, earnings are coming up and starting up this week and next, so we are pretty tight into earnings window. So it's going to be hard to find short-term trades in there. There are some long-term investment opportunities there, but probably waiting until after earnings come out for the financial sector. And then finally, let's go out to our Forex factory. Looking at the week ahead, important economic data coming out. Really nothing Monday, Tuesday. It's not showing it here, but crude light inventories, oil inventories are going to be released on Wednesday, so that'll be important. And then Thursday, big heavy hitter day with core CPI data, unemployment claims, and then going into Friday, core PPI claims. That'll be important. So economic data that is important this week, really centered on Thursday and Fridays. Keep an eye on that. Other than that, guys, trade safe. Enjoy your week. Let me know if you have any questions.